Welcome to the Women in Impact series, also known as WinImpact, hosted by Just Invest. Just Invest is a tech-driven asset manager that provides tax-efficient, hyper-customized direct indexing for financial advisors. We were founded in 2016 and headquartered in Oakland, California. On WinImpact, we bring together leading women in impact to talk about the innovations and challenges for financial advisors who want to offer impact investing options. Today, we have a guest with a wealth of knowledge around customizing and implementing ESG portfolios, and we're looking forward to having her break it down for us. I'm Rosanna, and this is Emily.
We're your hosts for the WinImpact series, and today on episode 6, we're talking to Luisa Gastambide, our very own investment specialist at Just Invest. Luisa is currently an investment specialist at Just Invest and an independent financial analyst and advisor. She started her career in the industry back in 2007 at Wells Fargo Advisors, where she became passionate about the investment industry. Before joining Just Invest, Luisa worked as a financial advisor at UBS Financial Services and in Merrill Lynch in Uruguay, where she focused on managing and allocating clients' funds with a global balanced portfolio approach. Back in 2015, Luisa left her position in UBS in Uruguay, and since then, she has focused her career in impact investment. She is now part of the Just Invest team, where she works on testing and data analysis for quality assurance of Just Invest's investment platform. Luisa has a CFA designation and is a member of CFA Institute and Argentina CFA Society. Luisa spends part of the year traveling abroad when we're not in pandemics and works from a variety of places where she has the opportunity to experience different realities. In fact, she's joining us today from Argentina. Luisa, welcome to the show.
Thank you, Rosanna. Thank you, Emily, for having me here. It's really an honor to me for me to be part of this great series you are doing on Women in Impact. I've been following this series and all the amazing women that joined you to share their perspective. So I'm really, really happy and excited to also be sharing mine with you. So thanks.
Absolutely. Well, let's get started. Luisa, we both started our careers in the financial advisory space. It's never been not interesting to hear about impact investing and what it means for clients and colleagues. And in your case, adding a global perspective, which makes it even more intriguing. What does impact investing mean to you?
Yeah, Rosanna, I totally agree with you because it's always interesting and it's insightful to hear others' perspective. So for me, impact investing is part of my lifestyle. I try to have a conscious lifestyle in every aspect of my life. And of course, my work is an important part of it. When I started my career in investment industry back in 2007 in Uruguay, where I'm originally from, I was in my last years of university and I was really, really eager to start putting into practice all my new skills. And I worked there for 3 years, US broker dealers, as you mentioned, but we were servicing the South American market, mainly retail investors from Argentina, Brazil, and Uruguay. And I developed my career there as a financial advisor. But after 7 years, in 2014, I had kind of a professional and personal crisis. And even though I liked my job, I didn't feel I was doing any good to our planet or to our society. To me, this was clearly the result of several factors. Primarily, this was a reflection of my own interest, and as I had really conscious mindset towards my life and my decisions. It was also the result of my family and childhood and how I was educated and the fact that I grew up living in a very, very tiny town in a rural area. It was, I think, a good mix that helped me grow with a quite conscious mindset. On the other hand, in 2013, I took a year off for traveling because I love to travel. So I went to Southeast Asia in a low budget trip. And this trip was a really, really enriching experience to me in many, many senses. When I went back home, I was lucky enough to get my job back in UBS, but I didn't feel I fit there anymore and I wanted to do something else. So after a year, I quit my job and moved to Argentina. At the time, in 2015, there was almost no talk about impact investing or ESG investment in South America. I felt I was the crazy person in my office who was talking about how the investment industry was not aligned with my values and my interests. And I wasn't even aware that impact investing was already gaining ground in other parts of the world. I definitely wanted to do something of the sort on the impact field. So I tried several projects. I even started a social enterprise with a friend, which was unfortunately short, but very good experience. So after struggling with my career for more or less a year, I heard about SoCap, this social capital markets gathering that it's held in San Francisco every year. And I decided to fly all the way to San Francisco to be part of it. And it really opened up a whole new world of investments to me. A few months later, I was very lucky to get in contact with Just Invest and started working in what I think is a great company that has an awesome team and products. And all of them are aligned with my values. So I'm really, really happy with the outcome. As you said, I usually travel a lot. Currently, of course, it's not the case due to the restrictions for the pandemic. But I usually spend part of the year traveling and some other parts in Indonesia, which is almost like my second house, and the rest of the time between Uruguay and Argentina. And I'm really happy to see that impact investing and ESG investing is a topic now among financial advisors in the region and in other emerging countries.
That's great. And Luisa, we are so glad to have you on our team. You work on testing and data analysis now, but I guess I'd like to take a step back and ask you to tell us about the big picture. What is impact investing and how does it work?
So in idealistic terms, impact investing is putting capital to work for improving our world. So as you can imagine, if we compare it to traditional investing, it involves a broader spectrum of factors that need to be considered in the investment decision process. To put it in simple words, it has two sides. It's an investment in its pure sense, and as such, we expect to generate a return for that capital we are investing. And at the same time, it intends to generate a positive and ideally measurable impact. So this capital is investing in companies or projects that generate a positive environmental social impact. When considering the impact of our investments, we need to have in mind that some additional factors that play an important role, which are, first of all, the balance between these financial and extra financial considerations we have. Then the balance on our short-term and long-term goals, such as profit and the sustainability of this profit along the time. And finally, we need to incorporate more stakeholders into the analysis, where we need to balance between their interests and also between the different generations of stakeholders is also important. Impact investing itself, as you've been talking in this series, it's not a new phenomenon, but it's currently there are some mega trends related to demographic changes or resources scarcity and new technologies that are helping to raise more attention to impact investing in the latter years. For example, there is more environmental awareness since there is more pressure on corporations to take responsibility for their impact, or how certain industries will evolve depending on scarcity of resources or the appearance of new resources. There is also a social awareness and more pressure on companies on how they should manage equality, fairness, their labor relations, which directly impacts their reputation. And there is also more governance awareness because corporation boards are required more transparency nowadays and good practices. And also the COVID pandemic has accelerated this process and put the discussion on sustainability over the desk. Yeah, no matter if you talk about impact investing, sustainable investing, ESG, SRI, SDG investing, all of the similarity between all these is that whether values-based or impact-based, we need to incorporate additional investor preferences into the investment framework. And this is a statement I would like to do. It's like, I believe that we as active actors in the investment industry have the responsibility to consider the impact of our investment decisions. The same way as we as humans should take the responsibility to impact the impact we have with our daily activities and decisions. And also investment professionals, or we as investment professionals, should also be aware that investing is not a static discipline, and it constantly evolves, and it is a challenge for us to keep up with it. Every day there is more and more evidence that support the need to incorporate impact investing into the investment process, and in order to preserve the sustainability of investments in the long term.
Wow, that's so much great insight there, Luisa. Thank you for that. Moving along to our next question. According to Morningstar, sustainable funds in the United States attracted record flows in 2020, with flows into sustainable open-end and exchange-traded funds reaching over $51 billion. That was a significant increase over 2019, when flows were $21.4 billion, and nearly 10-fold increase over 2018, when flows were $5.4 billion. How does technology help facilitate impact investing for advisors and their investor clients amongst so much growth?
Yeah, and that's impressive, Rosanna. Impressive. It really reflects the trend, which is significant. Indeed, technology has been a key player in facilitating impact investing and making it more achievable to a wider number of investors. Currently, there is more data availability as well. There are more tools and mind-blowing technology that we can put into use when we want to incorporate impact investing in our clients' portfolios. And Just Invest is a good example of how technology can help advisors, because this is exactly what we do, where we work with a great team of developers. And let me take a moment here to congratulate them, because I work every day very closely with them, and I'm really impressed of what they are able to do with technology. So as I was saying, thanks to technology and impact data availability, our team has been able to develop two great products, which are Kaleidoscope and Panorama, that are available in our platform for financial advisors to help them successfully manage their clients' portfolio in a quite effortless way. We at Just Invest do asset management with a technology perspective, and that is why we've built a strong platform which allows us to hyper customize the individual portfolio in a fast and efficient way. And we can integrate impact investing, direct indexing, and daily tax optimization to manage the entire household of the clients. Direct indexing is another key player I would like to highlight in relation with impact investing, which in combination with impact-related data and technology, it enables the advisor to customize the client investment depending on their values. Passive investment in general has gained a lot of market share in the last years, and even though it will probably not replace active investment, both can be combined in the portfolio construction through different vehicles plus direct indexing. And ETFs may be the most common and well-known vehicle for doing passive investment, but it does not allow for customization, and here's where technology fills the gap with direct indexing. The trend on direct indexing is not only explained by better technology, but also by several other factors, such as no trading costs, which were eliminated lately by US broker-dealers. And there is a higher demand from the retail investor as well. All these factors together and together with better technology are indeed supporting the rise of impact investing in the industry.
That's right, Luisa. With technology and zero trading fees helping to pave the way to greater adoption of direct indexing and therefore greater adoption of impact investing, we're very excited to see what comes next. So let's dive into this technology and talk about implementation. Since you work on data analysis and testing, could you dive into the details and share more about how to incorporate ESG in the investment process?
Yes, sure, Emily. And as I said, in Just Invest, we've managed to do that in our platform in Kaleidoscope, or KD as we call it. We use direct indexing to index the client portfolio to different market indices and regions, and we can combine it with many other analytics to achieve a really deep customization of the portfolio, and even of the entire household if we use Panorama, which is our other product. There are the traditional portfolio analytics we can use in KD, such as beta or a desired amount of cash to be held, maximum amount of tax costs generated by the rebalancing of the portfolio, minimum position size or minimum number of securities to be held. There are also, we can also incorporate tilts to different factors. So we can overweight or underweight securities based on its market cap, its dividend yield, the quality of its earnings, the historical volatility, etc. And in the impact spectrum, we can apply different methods to incorporate ESG or impact investment data in the portfolio construction based on the client's choices. One method is to do negative screening, because our technology allows us to specifically choose which sectors or industries we want to exclude. We can exclude securities that violate certain ESG factors, for example, environmental factors such as fossil fuels, or social factors such as human and labor rights, or even based on certain values such as abortion and gambling. We can also exclude specific securities that are held in the index, but maybe the client has a reason to exclude. Another method is called positive screening or best-in-class selection, and we can overweight different securities held in the index by choosing from a wide range of ESG analytics, such as high ESG score or low carbon footprint or gender diversity, etc. And the last method involves adding thematic tilts to the investment to invest the portfolio in based on certain demographic trends or industrial trends. This allows us to overweight securities with higher impact on, for example, things like education or sustainable agriculture or clean energy, to name some. All these analytics are incorporated into the investment policy and optimized to build the portfolio. So our portfolio managers can use all this technology and data and daily optimize the portfolios to generate tax alpha by daily reviewing the accounts on gains and losses and realizing certain losses and replacing those stocks by similar stocks held in the index. And if we want to go one step further, we can incorporate Panorama into the analysis, which allows us to allocate the assets in the entire household in a tax-efficient way, including the different account types like taxable and non-taxable. We also can include the trust and the entities that are part of a specific household. So I think technology is a key player because thanks to it, we are not only able to do direct indexing to incorporate impact investing and generate tax alpha, but we can also incorporate intergenerational equities and values into the portfolio construction, which I think is great as well.
That is such a great explanation. I think many of our listeners are going to benefit from the link between the work with impact and technology. So thank you so much for that, Luisa. Now, switching gears for a second, the elephant in the room. Is there a negative impact on portfolio returns and tax alpha if someone wants to incorporate ESG into their portfolio?
Yeah, I'm glad that you asked me this, because I think this is the biggest myth that needs to be knocked down. My answer would be not necessarily. There is really no impact evidence that suggests that an investor will have to give up return or tax alpha in order to invest their assets based on their values. In fact, research has demonstrated that performance for both ESG and non-ESG investments is pretty similar over time. From a risk perspective, many portfolio managers and fund managers are incorporating ESG factors into their investment process because there is evidence that supports that it improves the risk profile of the portfolio, and it can decrease factors such as volatility. So it makes sense to have an impact investing approach for portfolio construction to manage risk as well. Personally, I haven't seen a gap on performance, and we don't expect any over or underperformance in our clients' portfolio due to ESG factors. However, my personal belief, and this is my personal opinion, is that if we widen our investment horizon and think in the long term, there will be definitely a positive impact in performance if we start investing responsibly today and sustainably for the sake of our planet and our society.
That's great, Luisa. And now I kind of want to turn back to some of your personal experiences. As a world traveler who's passionate about ESG investing, I'm sure you have a broad perspective on the growing trend of impact investing. And I know you've touched on it earlier in this conversation. I know that I and many others tend to focus on ESG in the United States. So what is it like outside of the US? What are you seeing and hearing internationally now?
Yeah, so that's a good point, Emily, because as you said, most of the people tend to focus on ESG in the US, but it's also the region where there is more demand from the clients on this type of investing. So it seems natural to have that focus. However, the trend is global. Another region where impact investing has gained considerable traction is Europe and the Middle East. In South America in particular, I've noticed a big shift in the conversation towards ESG and impact investing in general in the last year. Now, most of the players in the industry have started to promote it and incorporate it into their clients' portfolios, which is great. I still see a lag in demand from the local investor, as they are still reluctant to invest with an ESG scope. Mainly, I think, because of the misconception of losing or sacrificing performance, which is one of the biggest challenges we still need to overcome in the local industry in South America. Obviously, I am more in contact with this region, but I also travel to other undeveloped countries in Asia and Africa, and I think the behavior and the trend is similar, and also the offer of this type of product or investment is growing there. And I think it's only a matter of time that investors start increasing their demand for impact investing as well.
That's right, Luisa, and thank you so much for that. That's so encouraging to hear. Well, thank you everyone for joining our Women in Impact series. And Luisa, thank you so much for sharing your important work with ESG technology and implementation. Before we wrap up, I also heard it was your birthday today. So happy birthday. It was truly our gift to WinImpact to have you spend your birthday with us. So thank you very much. Listeners, Please visit justinvest.com to access all of the resources mentioned during this interview and to learn more about investing with intention. You can also follow us on LinkedIn or subscribe to our YouTube channel. This is a wrap for us, and until next time, let's continue to win impact together. Investing done just right with Just Invest.